Hello, this is Julie Yasar. I'm a realtor working with the Houston, Texas area, especially Spring, Texas area actually. I'm working with the Realty One Iconic, and today I have a visitor guest. His name is Oktay Demirdal. He's a lender, and he's gonna tell us some of the most questions that I'm receiving and he's receiving. Can we start, Oktay?
Yeah, hi, how are you guys doing? I'm a loan officer licensed for the state of Texas with guaranteed rate. So Julie is one of my realtor partners that I work with, and I'll be happy to answer your questions, Julie. Go
All
ahead.
right, let's start then. So let's say I decided to buy a home. And what should I do the very first thing if I want to buy a house with the mortgage?
Well, very first thing, one of the first things should be, of course, find a good realtor like yourself. And
Thank
then, but along with that, you should definitely talk to a loan officer that you know or that you trust. It can be somebody at your bank. It could be somebody you know of in your circles, somebody who is being recommended by your realtor, for instance, and find out if you qualify or not qualify for a loan. That way you can save everybody, including yourself, a lot of time, um, you know, looking for a home and where you keep your hopes up. And in the end, you find out weeks later, you wouldn't even qualify for a loan.
All right. What is the difference between pre-approval or pre-qualified letter?
So pre-qualification is not as detailed as pre-qualification. I'm sorry, the other way around. Pre-qualification is not as detailed as pre-approval. So pre-qualification in many cases is based on verbal information. Like,
Yes.
for instance, you go to your bank or you talk to a loan officer and you tell them about your estimated credit score, your income, savings, without turning in any documentation, any statements from your bank, etc. And then they say in many cases, "Oh, okay, that sounds good. You know, it
Yes.
sounds like you would qualify, right?" So
Yes.
then they issue a
Yes.
pre-qualification. Many sellers, though, they require a pre-approval in today's market because, in Texas, honestly, in many areas, such as in Austin, where I live, or in Houston, in many
You have many customers
areas
in
of
here too.
Houston,
Yeah.
yeah, same way, the sellers actually many times require a pre-approval. So a
That's right.
pre-approval is usually the lender pulled your credit, you turned in your pay stubs, and also your bank statements, so they can verify the assets, or that they have a documentation at least. Verification is a different process down the road, but that's basically the difference.
More
So
stronger than the other letter actually. Okay.
absolutely. Pre-approval is a lot more thorough based on documentation. Pre-qualification in many cases is a
Based on what you say
verbal,
actually.
well,
Yeah.
maybe one document was turned in, but not others, that
Okay.
would prove that you would be qualifying.
Well, in these days, everybody knows their own score, right? Credit score. Let's say I know my score too. So, do you still need to check my score?
Yes,
Credit score, I mean.
especially, I mean, the initial request, if it's not an official application, I can work off of the credit score the borrower mentions, but for an official application, absolutely, it is actually one of the mortgage rules or requirements to pull the official credit along with the application. Okay, it's part of the application, so it needs to be pulled.
Okay.
However, here's a misconception. So although it is a hard pull, but the scores in many times not go down as much as, I had a borrower who went and bought a pre-owned car, and little he knew, his credit score was requested by 10 different possible, or I guess the dealership was working with 10 different car loan companies, and then it was requested 10 times. So that doesn't happen here when we pull credit. And also, if within 30 days, if you have your credit checked for loan purposes, it only goes down once. Okay. So, and usually it's only 4 or 5 points that it goes down temporarily. Okay.
Okay, that's
you
not a
won't
big
see
deal.
the 20 to 40 points that, it wouldn't go down as much.
So let's say I am not good. I don't have good credit, or I have some debts. So, what should buyers be prepared for when applying a loan before
So
what they do? What can they do actually?
Yeah, so as far as credit score, the credit score is the one thing that determines your interest rate, what interest rate you qualify for. Okay. So in other words, the higher your credit score for a conventional loan or for a quality mortgage, usually 740 and up would give you the best credit scores. I mean, not the credit score, but the interest rate. So the lower your credit score, the higher the interest rate. Okay. So currently, FHA and conventional minimum required credit score is 620. However, with 620, I locked in a rate at 3.125 for a client this week. And with a score of 620 to 650, even 660, it would be probably somewhere around 4. Okay.
All right. So, what are points?
Points are also called discount points. So it is basically the fee that a borrower would pay to buy down the interest rate. So let's say 3.125 is a 30-year, for a 30-year conventional loan is the interest rate. But the client has a targeted interest rate of 2.75. Then the borrower can do that. However, there would be a charge to go down to that interest rate. Okay. So, and that brings up actually a good point. Many of my borrowers or clients, they usually go to a major bank. Let's say they're banking with Chase, for instance, or Wells Fargo, or one of those major banks, and then they get a rate, let's say, 2.75 to keep the numbers the same. And then I quote them 3% for a 30-year. But the difference is they're maybe charged then 2 points to buy down to 2.75. So that is really not an apples to apples comparison. So the comparison should be, what is their interest rate? What should I compare without points? And then what should I compare at 2.75? Who is charging me more than others? Okay, so the importance of this is, let's say the loan amount is 400K and you're being charged 2 points, 2% off of that. So your closing costs essentially are going up by $8,000. Okay. So you have to calculate, you have to decide how long you want to stay in that house or keep that house before you sell it.
It's the advantage for me.
Right. And then you have to see if you can recoup those $8,000 or when you would recoup it. In many cases, it's actually up to 10 years or even more sometimes. So discount points might not make a lot of sense. In many cases, they do not make sense because I think I saw somewhere the average years homeowners keep their house before they sell it is somewhere 7 or 8 years, but it has been a while since I read it. But I think you need to do the math and decide if it's really worth it.
Yeah, if you plan to move longer the house, and buying an interest rate would be helpful. Otherwise, you're saying it's not helpful. You're just out of pocket goes away, but it doesn't
Right.
worth it. Got it, right?
Yeah. You have to bring more cash to
Yes.
closing. I mean, it's in many cases
It's not
it
worth it.
doesn't
I
pay
got
off.
it. Okay.
Yeah, it very rarely it makes sense. Okay, if the points are little, like let's say 0.25, just a
Yeah.
quarter of a percent, it's a small
It
charge.
doesn't make
In that
sense.
case, it would be only $1,000 more for closing costs. But the difference in monthly payments is, let's say, $50. Okay,
Mhm.
so then 50 times 12 is 600. So within a year and a half or so, you would recoup those $1,000, and after which you would be have a major advantage. Okay,
Okay.
so it depends. Okay, how high, what the charge is, and what the points are.
So there are another questions. There are many loan types,
Yeah.
and can I pick those? What is the usual ones? I know many, but can you mention a couple of names to us?
Yeah. So all FNMA backed loans that are basically backed, governmentally backed, let's say Fannie Mae, Freddie Mac,
Mm-hmm.
uh, you know, um, under their umbrella. So many of those loans, it depends on the individual situation. Wherever I can, I qualify a borrower for a conventional rate because I think it still has,
Most
especially
common
if
one,
somebody,
right? Most common
right.
one. Okay.
Yeah, and there's an FHA that is usually, FHA stands for Federal Housing Authority, usually a program to help borrowers that have either credit challenges, their credit scores is lower, they have limited savings, they have that their debt to income ratio is very high.
Mhm.
Usually they're getting approved, whereas conventional, it really makes more sense if you have higher credit scores, enough savings with reserves, and your debt to income ratio is at about 45 or below 50. Okay.
Okay. So I'm the first time home buyer, let's say, and I don't have 20% the down payment. So is there any way I can avoid PMI, or is there any way I don't have to pay 20% off?
Yeah, I mean, there is no obligation to pay 20% down. The 20%, if a borrower has savings that would cover that 20%,
Mhm.
would get them out of the mortgage insurance requirement that is mandatory. And for first-time home buyers, a conventional loan you can get with as low as 3% down payment,
Great.
or an FHA is 3.5%. So there's no obligation to pay down 20%. Of course, you would have to pay the mortgage insurance.
Yes.
But for a first-time home buyer, usually there are a few benefits. One of the benefits is if the income is below a certain
Limit.
level,
Mhm.
then exactly, then it is a little lower than what the borrower would normally pay.
So is there any assistance program, down payment assistance program that people
Yes.
can use?
Yes, there are programs like that, and some of them, they do the down payment for you. Like, let's say in that previous example, 3% for a
Mhm.
conventional. So they pay the 3% for the borrower. But here's the misconception, right? The borrower still needs to pay in many cases the closing costs. So those are not little amounts usually, especially if you're making a 3% down payment, you have to pay into an escrow account the prepaids, and there are other fees, lender fees usually, title fees. Okay, so the borrower still has to pay the closing costs. Also, usually to recoup that down payment those loan programs make on your behalf, usually their interest rate is a little higher. Actually, sometimes not just little, but a lot higher. We're talking, 5% currently. Plus, the processing takes a lot longer. So currently, our processing times from the application until closing is about 30 days. So those programs usually take longer, up to 60 days. I've even seen 75 days. And the more the market is competitive, the more competition is going on the market, the less the sellers are willing to wait until, so if, let's say there's a house priced right, great house, and there's multiple offers on it. So the seller would look at the pre-approval letters, and then they would look into the details, what kind of loan program, whether FHA conventional or down payment assistance program. And I guarantee you, in many cases, they would choose whichever program would close the soonest. Okay, so the seller, of course, has an interest in having the closing done as quickly as possible, because every day they don't sell the house, it means a cost that is associated with it, like for taxes, for instance, right? Yes. Or other expenses for HOA, etc. So that's another disadvantage of those programs.
Yes, but so much requirements.
It is a little bit more rigorous processing for sure.
Yeah.
Yes.
So let's say I don't have any credit history, and what documents do I need in order to get a mortgage?
Honestly, what I would recommend in that case is to talk to a credit expert, or a loan officer, or some sort of someone who deals with this frequently. Usually, if somebody doesn't have a credit history, that means they're either new in the country, they have been gone, they're
long time,
and they haven't been living in the States for a while. But honestly, it can be built up fairly quickly. I've seen as quickly as 6 months or so, or a year. So that's a basic requirement. But there are also loan programs that, bank statements only, for instance, where a borrower, although they don't have any credit history, they can, get a mortgage loan nevertheless from private investors. Those wouldn't be government-backed loan programs, and usually they require about 30% down payment. So, you can still get a mortgage, but
pros and cons. So
it is
either wait a little bit or do what they told you to do.
Rates are usually higher too. Yes, we're talking about 2% higher than what the market rates are right now.
Okay, so
and it is a process that takes a little longer. So that's, you can get a loan.
Think twice, I would say then. Think twice, right?
Yes, okay. It would.
Okay, and my last question is, how long does it take to get a loan mortgage?
So it used to be 21 days, about 3 weeks, but right now, due to the corona pandemic, it takes us around 30 days, which is not bad given the fact that we're dealing with exceptional, difficult times right now.
I know.
The processing takes a little longer. I mean, the appraisers are not as readily available as they used to be. So it is a little bit, it takes a little longer, but 30 days is what we're doing currently. It used to be 21.
All right. Thank you so much.
Yeah, you're welcome.
Thank you for listening us. See you next time. Bye-bye.
Bye-bye.